Dear ladies and gentlemen, we warmly welcome you to our IFRS 17/9 teach-in, with which we want to give you a brief overview of what the new accounting standards, IFRS 17, IFRS 9, mean for VIG and how we are going to implement this new regime. More than 500 colleagues in 45 group companies in 23 countries are involved in this program. During the project, over 50,000 portfolios got processed, tested, and validated with the necessary quality checks. We have been running our group-wide IFRS 17/9 program since the end of 2017, and we see ourselves well positioned for the new financial reporting starting next year, 2023. To make the best possible use of the accounting change, we focused on the harmonization and reduction of complexity, meaning simplifications where possible. We have, just to give some examples, unified our actuarial models. We have accelerated the rollout of group-wide IT system. Here I would like to mention SimCorp Dimensions for our investments. And we have introduced a newly developed insurance technical subledger called SAP Financial Product Subledger, FPSL. In order to achieve consistency and comparability with our peers in this area, mainly focusing on KPIs, we are in contact with industry organizations like, for example, Insurance Europe. And I would also like to mention the SAP FPSL user group. Let me please take the opportunity to thank all the colleagues throughout the group and all our external supporters for their effort in the past years and their ongoing commitment. Representing all those involved, Roland Goldsteiner, our head of finance, and Vienna Matula, our chief actuary, are here with me today to present and share the current status of this IFRS 17/9 implementation at VIG. Please let me add that the information today is based on the best of our knowledge up to now, and we are still fine-tuning things. Vienna will start with the measurement models under IFRS 17 and their application at VIG. Roland will then guide you through the accounting options and how they are handled at VIG. I will talk about the next steps at the end and give a first indication based on the opening balance sheet as of 1st January 2022. Afterwards, we are here and we are happy to answer all your questions you might have in a Q&A session. With this, I would like to hand over to Werner to guide you through our measurement models. Werner, please go ahead.
Thank you very much, Liane, and good afternoon, everyone. It's my pleasure to present to you a bit of a methodology regarding IFRS 17 today. As you probably heard already, IFRS 17 introduces a new measurement model and variations of such a model, and they are depicted on this slide. We have a general measurement model. That's the default measurement model. We have a variation of it, which is the variable fee approach, the VFA, and we have a simplified model. That's the premium allocation approach, PAA. I would like to go a little bit more deep on the following slides, but here it's like a summary of how VIG interprets and applies the various measurement models. We are using all three of them in the group, and I would like to start on the right with the simplified one, the premium allocation approach, which can be used. It's an optional model. It can be used for contracts which have a duration less than 1 year, short-term contracts. And we are using this one in particular for our non-life business. That's a short-term business in general, sometimes also for health and life business in case we are talking about short-term contracts. But the vast majority of non-life business is accounted according to the premium allocation approach. The long-term business, life and health, typically is modeled or valued according to the GMM or the VFA. If the VFA criteria are met, then the VFA approach is a mandatory one. So that's not an option. That's really a must to apply. And one can think typically about unit-linked business here, but also long-term traditional life business with profit participation would fall into this category, or the long-term health business in Austria. Or the remaining businesses, this would be, say, non-participating life business in general would be measured according to the general measurement model. If you're looking on the balance sheet items, and you see here on the slide the abbreviations LRC and LIC, that's the liability for remaining coverage. The new terminology for the premium reserve items, we used to say mathematical reserve or unearned premium reserves in the past, or the liability for incurred claims, that's the claims reserve. If we look at the items here, then the premium allocation approach allows for the liability for remaining coverage, a simplified one, a simplified valuation. Practically, we are staying like under IFRS 4 with an unearned premium reserve there. The new items, the contractual service margin or the risk adjustment, we see them in the LRC for GMM and for VFA. And when it comes to the claims reserve, there is no difference between the three measurement models. It's always a best estimate cash flow, a PV, a present value of cash flow, plus the risk adjustment. If we go now a little bit more detailed to the first one, the GMM, the general measurement model on the next slide. So what are the components of the liability for remaining coverage in the GMM? It's a building block approach. So we have say 4 building blocks here. We have estimates of future cash flows, we have discounting, and we have risk adjustment. Those 3 blocks create or add up to the fulfillment cash flow. And what's that? So obviously the estimates of the future cash flows are inflows, typically premiums, and outflows, typically the claims or the costs. And here it's worth mentioning costs are considered here as attributable expenses, so those expenses which can be directly attributed to the policies. Then we allow for the time value of money and financial risk by discounting. Here it's worth mentioning that VIG applies here it determines the discount rates by a bottom-up approach. So that's essentially a risk premium plus a liquidity adjustment. And then we add a risk adjustment. The risk adjustment under IFRS 17 allows for the uncertainty of the expected cash flows. And we end up with the fulfillment cash flow. On top of the fulfillment cash flow, we see the contractual service margin. That's a really new item in IFRS 17. We haven't seen such an item in the liabilities under other regimes like Solvency II or MCEV. The contractual service margin represents practically the future profits or the unearned profits, as long as a contract provides service in the future. How is it established? The CSM is established at initial recognition. So the first time a contract is recognized, we are doing exactly this calculation as shown in the waterfall, and the result is the contractual service margin and would be then adjusted and released at the future subsequent measurements. If we go to the next slide, that's a quick summary of the variable fee approach. As already mentioned, this approach has to be applied in case certain criteria are met. And this is in particular the case if a underlying item can be identified. So one should think here of a unit-linked contract. The unit-linked contract has an underlying item, the investment fund, and we are, as insurer, obliged to pay a fair value of the underlying item to the policyholder, and we are taking a fee out of the underlying item. That's the variable fee here, and this results in the obligation to pay to the policyholder the present value of cash flows. That's visible here in the chart on the right. What is important to mention here is that we are using this approach also for the traditional business with profit participation. When is this the case? That's the case if the profit participation is, so to say, enforceable by either law or by contractual terms and conditions. And the same also applies for the long-term health business in Austria. What's the difference to the GMM? The difference to the GMM is in particular when looking at the adjustment of the CSM. So the building blocks are the same, like for the general measurement model. Also, the calculation of the CSM and initial recognition is the same as for the GMM. But if we see a change of our share in the fair value of the underlying item, this change adjusts the CSM. So practically, we can also book market value fluctuations against the CSM, and this is reducing accounting mismatches or volatilities for such kind of policies. If we further look now on the third one, the premium allocation approach, already mentioned, that's a simplified measurement model, and it's an optional model. So this could be used, and VIG decided to use this one for the P&C, for the non-life business, especially if we have like 1-year policies. But also in some cases for longer durations, we would apply the premium allocation approach. Obviously, then we need to prove that it's eligible by showing that the results would not be very different or substantially different to the GMM. Let's go to the next slide. And I think this one is the first slide where we show some numbers and give some indication how our reserves are decomposed. And it's interesting to see that 77% of our reserves are measured according to the VFA, the variable fee approach. This is due to the fact that we have significant book of life and unit-linked business, in particular in Austria. Then the second biggest one would be the premium allocation approach with 16%. That's essentially our non-life business, and the remaining 7%, this would be the non-participating long-term business, is 7% GMM. So that's the first indication. And then one more maybe methodology topic on the next slide. It's about the level of aggregation. All this measurement, we are not, or IFRS 17 is not requiring us to do this policy by policy. So we are allowed to aggregate to a certain level, and the level is then called group of contracts. What are we doing? We're looking on 3 dimensions. On portfolios, first of all. Portfolios are policies with similar risk managed together. And here it's worth mentioning that VIG is here aligning with Solvency II lines of businesses. So the portfolios for us on the group level are aligned with Solvency II for comparability purposes. Then the second dimension would be annual cohort. So that's the underwriting here. In this case, we have the one or the other exemption, especially for mutualized contracts. And I think Roland will go in more detail about this topic later on. And then the third dimension is looking at the profitability of the cohorts. We need to separate whether policies are not profitable. In IFRS 17 terms, we would call this onerous or not onerous. In our case, in VIG, we're staying with those 2 categories. And then this leads to the group of contracts, group of insurance contracts, and we are doing then the valuation on this level of granularity. So this would be a quick introduction about the methodology. There is obviously much more to say, but I think I would like to hand over to Roland for the accounting options and certain decisions taken at VIG in terms of IFRS 17 and 9. Thank you very much, Roland.
Thank you, Werner. Also a very warm afternoon from my side. We are quite proud to present also the next upcoming slides here, which are more or less, let's say, the major accounting choices we have taken, which IFRS 17 or IFRS 9 has provided us. Let me first start with that, of course, as every principle-based standard, as those both major standards are, we had the main task as a first step to interpret all these standards and paragraphs in these standards here. Let's say the big exercise was to interpret these standards without having any, let's say, quantifiable numbers to run through all these options for what we have. But nevertheless, I think after many rounds of consultation and thinking about, we came up with the major choices here we want to present to you. And these are the interpretations and the options we have taken. We will and we want to base our financial figures for now and also for the future. Let's first start with the discount rates we have taken to calculate especially the technical reserves and the IFRS 17 parts. Here is one of the main principles we employed during the taking the choices here, which was to be as congruent as much as possible with Solvency II regulations. Why we wanted to make such a, let's say, a very narrow path here to the Solvency II regulations, because those are these standards we have to oblige to fulfill, and these are the two standards which provide us figures for the financial part on the one hand, and for the risk and the solvency part for the other hand, how we steer our companies and how we steer the total group here. And here we wanted to be as compliant between those standards as possible. Therefore, we have chosen an approach which is more or less also the Solvency II approach, meaning we have taken the bottom-up approach, taking the risk-free rate plus the liquidity premium if this is applicable for the certain countries and in a certain height. What's the difference to Solvency II? Of course, in Solvency II, you have also the risk-free rate, but you have a very well-known component, meaning the volatility adjustment, which is not the case here in IFRS 17. Here you have the component of the liquidity premium. The principle is more or less the same, let's put it like this, but the amount of the correction of the base risk rate is a little bit different. But nevertheless, when we look on the curve over the time, you will see that it resembles very much the IAOPA interest rate curve here. Also, the discount rates play a big role also during transition, which is a topic I will come afterwards also to a little bit more detail. Here we have taken on a very big chunk of our portfolio the fair value approach. And therefore, we needed the cost of capital approach for the Solvency II own funds projections here. And therefore, we have also a big alignment with the cost of equity rate we employ within our group. Second accounting choice we've taken is how to deal with the risk adjustments and how to calculate it. Also here we used an approach which is rather similar to Solvency II. Meaning we wanted to have a distribution of the uncertainty of the cash flows over the lifetime of the contract, which resembles very much also Solvency II. Nonetheless, we also forced over the lifetime of the contract to periodically review these based assumptions here on the current cost of capital, of course. For IFRS 9 securities, we have taken an approach which very much resembles also overall risk strategy for investments, meaning we want to reduce as much as possible the volatility out of market swings and market rate developments on the financial markets here. Therefore, we decided to distribute as much as possible to the category fair value through OCI. And don't go so much as to a category where the swings of the market and development goes through P&L, meaning fair value through P&L here. This was one of the principles how we dealt with the investment portfolio. Of course, the other one was we have to distribute the investments due to our business models, of course. And as this is a very, would say, conservative model here, also this takes, would say, its footprint also in the distribution of the investment portfolio here. Another topic here is how we treat the participations within the group. As these are investments which are not held for trading, or the profit on short swing gains here, we decided to classify them also as fair value through OCI. And taking the, would say, the non-recycling feature what we have here into acceptance. For many topics here, the IFRS 9 here is applicable, but for the last topic I want to mention here is real estate, and here we can say we still stick to our principle that we value own used real estate and also investment property at purchase value minus regular depreciations. So we don't go over OCI or through P&L for the market value swings here. On the next slide, we go to also to the next decisions we've taken, which first of all is we decided to account for figures on the year-to-date basis. This IFRS 17 standard also here employs other options which we don't want to take, because in our view the figures must be the same regardless how often we calculate this over the year. So meaning this shouldn't be, I would say, a burden on us how often we publish, how often we calculate for internal or external purposes our figures here. Therefore, we decided to clearly go year to date. For the annual cohorts, like Werner has already mentioned here, we've also taken use of these options here, especially for the long-term life and health portfolio, which we have in our group and which we have mainly in Austria. Why have we done this? Because according to our business model, this is the presentation we think which best fits also our business model here from the point how these contracts are bundled and how the effects out of this bundle of contracts will be pictured during the financial accounts here. Therefore, we were quite happy to have this option here when we have taken use of it. Last but not least, we'll come to the group of contracts here, which we want to present to the public and also for internal purposes here. And this is also one of the examples we said we want to stick as near as possible to the Solvency II lines of businesses here. Therefore, we've taken the decision to cut the total portfolio of contracts here to mainly the same lines of business here. Here, the main advantage we see is that we have as much comparability to Solvency II as possible here, because we want to steer IFRS profitability in the same way as we want to steer own funds creation here. On the next slide, we want to present you how we have taken the choices during the transition, meaning of furnishing the opening balance at the 1st of January of 22. IFRS 17 standard here provides 3 approaches in general. Of these 3 choices, we have taken 2 within our group. The third one, the modified retrospective approach, which is in the second part here, we've only taken as a modeling example for quality assurance purpose, but not any portfolio was calculated in the financial statement of 22 according to this model here. What we've done mostly is take for the long-term business the fair value approach, the VVA approach here. Why we have done this? Because one of the reasons was the limitation of the availability of necessary data to calculate this in a way which really represents the nature of these long-term contracts within the group. And the second one was that we have here, would say, the best fit in the fair value approach here, according to the financial presentation here. And talking about the CSM and all the technical provisions what we have in the balance sheet, most of them were here computed and calculated according to the fair value approach. Coming to the third approach, we've taken the full retrospective mainly for the P&C business here due to the short duration of this business. So we have a quite direct match between those portfolio where we have a calculation according to PIA, and these are the ones where we have taken the fair value, the full retrospective approach here. And only for a very, very limited amount of portfolios, we have calculated here the technical reserves for the total balance sheet here. Good, so much for the options here. Last but not least, I want to present you how we want to portray the balance sheet and the P&L in the future here, which of course is not a final presentation, but what gives you, let's say, a flavor of it. As you're accustomed to us as one of the IFRS 4 presenter of financial figures and the P&L and the balance sheet, you well know that we've taken, I would say, the accrued premium approach of the presentation here, meaning we started the P&L mainly with the gross written premium minus the accrued claims, minus the accrued cost, and come up with the profit before tax and plus the financial income here. This is a presentation which will not run under IFRS 17 and 9, of course. Here we have totally different items here, and these items are totally different bundled according to the sources where the figures come from. And also the connectivity to the balance sheet is also totally different. For instance, take, for example, the insurance revenue, which is not anymore just a pure cash flow quality, but takes also very much the expected figures into the calculation, also other features like the risk adjustment and the CSM, for example. Therefore, the picture we will present you for P&L especially will totally change to what you are accustomed to from Vienna Insurance Group in the past. And also, last but not least, as you know, as a gross written premium, we have stated here the total premium income here, what we had in Vienna Insurance Group. This is also not possible anymore due to the regulation that in the investment component, which is especially in the life insurance business, a very big component in the cash flow streams here, will not be presented in the P&L anymore. And also, the other implications for KPIs and others, this will be Liane's part here after my part, and therefore I will thank you very much for the opportunity to present the choices we've taken, and back to you, Liane.
Thank you, Roland. Now I would like to explain to you the next steps and also the first indications of the transitional balance sheet. The new balance sheet as well as the P&L presentation, of course, also mean new potential key performance indicators, KPIs. And we see IFRS 17 to help us to improve the consistency across all the metrics. At VIG in the past, under IFRS 4, we always used the premium development, gross written premium, the profit before taxes, PBT, and the combined ratio for the non-life as KPIs. At the full and half-year results, we are currently publishing our Solvency II ratio. Going forward from the next year on, we are planning to provide the solvency ratio to you on a quarterly basis in order to help with this known and well-established KPI following the transition to IFRS 17. The potential set of KPIs under the new regime for VIG is now shown on the slide 15. We will, of course, have KPIs for measuring the development of our top and bottom line and the combined ratio, the latter with an amended calculation method. This will stay part of our continuous reporting. Going forward, the CSM and KPIs with regards to the CSM development will be added, as well as the operating ROE. For all these KPIs, we want to have more data points as they need further testing and calibration. We are currently preparing quarterly interim financial statements in parallel based on our current accounting standards IFRS 4 and the new accounting standards IFRS 17. And we are also running the financial planning process for 2023 to 2025 already under the new IFRS 17 regime. Based on the outcome of this, we will present our financial targets for 2023 onwards. Moreover, we are, of course, also closely following the industry disclosures as we want to align with our peers with regards to the new KPIs. Given the volatile market environment and our current limited experience with the new accounting regime, we will therefore wait for the full year 2022 IFRS 17/9 results to include this in our consideration for the KPIs and respective VIG targets going forward. This brings me to our reporting roadmap on slide 16. Here shown on March 15, 2023, VIG is going to publish the preliminary full year results of 2024 for the last time under the current accounting regime IFRS 4. The final full year results 2022 under IFRS 4 will include an overview of the IFRS 9 and 17 transition impacts in the disclosures. We are currently planning to use the Q1 update on 31st of May 2023 for an in-depth presentation of IFRS 17/9 transition impacts and consequences based on the audited transitional balance sheet 1st of January 2022. The first set of IFRS 17/9 results will be the IAS 34 interim financial statements for the half-year results 2023, which will be released end of August. The first full year results under the new accounting regime will be the financial year 2023 results, which we will present in the first quarter 2024. For the results of the first 3 and 9 months going forward, we will keep our regular conference calls, but will focus on qualitative developments in our markets. Similar to many of our peers, we will not provide a full balance sheet and income statement as it is currently the case for IFRS 4. You might have noticed also in our financial calendar for 2023 that we have used the term update for the first quarter, for the first 3 quarters 2023. We want to stay in touch with the investment community and give analysts and investors regular updates on the operational business developments in our markets. We will include some sort of top-line measure as well as the solvency ratio, as already mentioned, from 2023 onwards on a quarterly basis. Now, on the next 2 slides, we have prepared illustrative flowcharts with the reconciliation of IFRS 4 equity to IFRS 17/9 equity, which is shown on slide 17. Now here, first, really positive thing to mention is that VIG's IFRS 17 equity as of 1st of January 2022 is only slightly below the level of our IFRS 4 equity. Equity transition impact mainly derives from current IFRS 4 accounting choices. I would like to remind you here that in the past, we always applied IFRS 4 accounting choices on a conservative level or with a conservative approach. For example, we had a prudency due to case-by-case reserving in P&C, which is now superseded by current measurement model, which has to be used under IFRS 17. And of course, also IFRS 17 accounting mechanics are here to be mentioned. IFRS 17 in general leads to a more back-ended profit recognition through the creation of the CSM, which is shown as a liability. IFRS 17 also introduces discounting, a risk adjustment, different level of aggregation, and also it has to be mentioned that transition calibration topics are included. Both has been explained to you already by Vienna and Roland. Now, equity reducing transition effects mainly include the transition effect, which is shown in the first column, which largely derives from the elimination of IFRS 39 valuation methods regarding our investment portfolio. And this is related to the net of unrealized gains and losses, less deferred policyholder participation, and less deferred taxes. Positive IFRS 9 OCI effects are driven by the fact that an increased number of financial instruments are now to be measured at fair value in the new regime. Unrealized gains and losses for most debt securities continue to be recorded through OCI. I would like to mention here again that real estate continues to be valued at amortized cost. Here in these areas, we have considerable hidden reserves in the amount of approximately 1.8 billion euro gross, which are not included in IFRS equity, neither IFRS 4 nor in future IFRS 17. The positive IFRS 9 OCI effects outweigh the negative IFRS 17 OCI effect at the transition date. The main reason for the negative effect of the IFRS 17 OCI effect is the creation of the CSM for long-term health and long-term life business. Overall, we end up with a very solid equity base also under the new accounting regime. Now let's move to slide 18. Here we have prepared an indicative IFRS 17/9 equity reconciliation to the own funds under Solvency II as of 1st of January 2022. This chart shows that our ambition to align the IFRS 17/9 implementation as much as possible with existing regimes, namely Solvency II, was successful. For example, the best estimate liabilities will be similar to Solvency II, as well as the approach in setting the discount rates, already explained by Roland, a bottom-up approach based on the risk-free rates plus an liquidity adjustment based on VIG's group companies' portfolios instead of industry average. IFRS 17/9 equity plus the expected CSM after reduction of intangible assets in our IFRS balance sheet and adding back the hidden reserves from real estate, which have to be included in own funds, as already mentioned on the previous slide, brings this adjusted IFRS 17 equity close to our Solvency II own funds. Let me also add here that IFRS 17/9 does not have any direct impact on the solvency ratio, given the fact that Solvency II is already based on market consistent balance sheet and applies economic valuation principles. Before we start our Q&A session, let me please quickly summarize all three sections that we have presented to you. IFRS 17/9 is a new accounting standard, and it changes fundamentally the way our results are going to be presented in the future. But it does not change VIG's strategy, it does not change our risk preference, and it does not change our business model. Our guiding, or one of our guiding principles remains: accounting follows business. We will also keep steering our group market by market, which means that our segmentation will stay unchanged. Our reporting segments, Austria, Czech Republic, Poland, extended CEE special markets and group functions will remain also under IFRS 17/9. Business-wise, for P&C IFRS 17/9 means limited impact due to the use of the premium allocation approach. The combined ratio will also stay as a KPI for the profitability of the P&C business, of course, with adapted calculation. For life and health, we don't need the separate embedded value calculation anymore from 2023 onwards. The contractual service margin and the new business CSM will provide clarity with regard to the profit drivers and better reflect the long-term nature of our business. The variable fee approach, VFA, which amounts to approximately 75% of the technical reserves in this measurement model is dominant for life and health. With regard to first insights from the balance sheet transition, VIG's IFRS 17/9 equity stays at a comparable level as under the current regime IFRS 4. IFRS 17/9 equity, including the CSM, contractual service margin, is at the level of our Solvency II own funds. Finally, I would also like to mention that total assets under IFRS 17/9 stay above 50 billion euros as at transition date, and thus slightly only below the IFRS 4 level. Let me also add here that the new accounting regime, IFRS 17/9, does not change the dividend payment capacity as for all bigger VIG entities, and this is including Austria. Local GAAP remains unchanged and will continue to stay as the basis for dividend payments. As already mentioned, regarding the P&L and future KPIs, we want to include the results of the IFRS 17/9 full year results 2022 on the one hand, but also the insights from the financial planning, which we are currently running for 2023 to 2025. We want to include this. We will share more details with you in 2023 then. With this, we have come to the end of our presentation, and we are now happy and ready to take any questions you might have. Thank you for listening.
Ladies and gentlemen, at this time we will begin the question and answer session. Anyone who wishes to ask a question may click the Q&A button on the left side of your screen and then raise your hand. If you are connected via phone, please press star followed by 1 on your telephone keypad. If you wish to remove yourself from the question queue, you may press star followed by 2 or press the lower your hand button. If you are using speaker equipment today, please lift the handset before making your selections. Anyone who has a question may click the Q&A and raise your hand button or press star followed by 1 at this time. One moment for the first question, please. And our first question is from the line of Thomas Unger from Erste Group. Please go ahead.
Hi, good afternoon. Thank you very much for this presentation. Very helpful. I have a few questions. I'm coming back to the highlights, the executive summary at the very end. You've mentioned that you will no longer be reporting the embedded value separately, and maybe I'm asking Mr. Matula here. What are the main changes now in the accounting transition? Going with respect to the embedded value reporting, is the value in force replaced by the CSM now, or is that, or will it remain a key performance indicator also in the future? That would be my first question. The second question would be on, you very briefly touched upon the dividend payment capacity that remains unchanged, but does the new accounting regime change anything in your dividend policy going forward? And then maybe lastly, I hope you can answer a third question here. If you could give us a feeling for the P&L, what are the main lines in terms of profitability that you'd be highlighting in your presentations? Is the operating result, the net result? Are you adjusting the net result for any effect? Yeah, those would be my questions for now. Thank you.
Vienna, please go ahead with the first question.
Very much. I will take the first question, obviously. Embedded value versus IFRS 17. Yes, it's correct, as Liane mentioned. We will finish MCEV reporting as we finish IFRS 4 reporting. We did the supplementary disclosure of embedded value always in order to also show the profitability of the life business, which is not so visible in IFRS 4 terms and financial statements. We have components there, such as you mentioned, the value in force. We have their new business values. We see the development of the embedded value in earnings analysis terms. We have sensitivities, etc. Now that we're moving to IFRS 17, we are moving also to a market consistent valuation and the market value balance sheet. So obviously, this is much closer to an embedded value already. And the KPIs which we used to show are not the same, obviously, anymore, but pretty much the same. You mentioned the contractual service margin, which represents future profits or unearned profits. So that's a comparable KPI to the value in force. We have a new business contribution to the contractual service margin, which will be also disclosed in the CSM movement disclosure. So we have a comparable KPI to the new business value, and obviously we can also do margins out of this. There will be differences since there are certain regulation. I think I mentioned the topic of costs. They are treated a little bit differently under IFRS 17. We have different treatments of contract boundaries due to the view of, or the contractual view, and not like under Solvency II and MCV for us, the view according to the various risks. But more or less, it's not necessary to have an MCV disclosure anymore if the KPIs say the same. So we will really finish the story of MCV together with IFRS 4.
Cool. So regarding your second question, dividend payments, I already mentioned that the dividend payment capacity does not change because all of the larger companies or bigger dividend paying companies are continuing with local GAAP accounting, and this does not change or is not influenced by IFRS 17. And especially this is true also for Austria and for VIG Holding. So the dividend capacity remains unchanged. Our dividend policy, which is currently under IFRS 4, to pay dividends between 30 and 50% of net profits, it will be kept with until 2022. And when we have the numbers of the 2022 comparative figures, IFRS 9/17, as well as the results of the financial planning 2023 to 2025, which is currently running, all this together, we will evaluate our financial targets going forward. For the time being, we have our dividend policy, and we will reach out to you as soon as possible as we know or have further information on the P&L developments and the planning for the ongoing years. And let me also let me highlight here also that since we are listed 1994, we have paid dividends each and every year, also in 2020. And we will, I'm sure, continue to let our shareholders participate on our success. This is for the time being everything I can say to the dividend policy and payments. So I would like to hand over to Roland for your third question regarding P&L development and net result.
How should I answer this? Having seen any, would say, full P&L of the insurance group till now, according to IFRS 17 and 9 at the moment. Let's put it like this. what we say estimate to see here is, of course, we'll estimate a little bit more volatility in the profit before tax area here, due to the fact that we have a larger parts classified of the investments according to fair value through P&L compared to the IFRS 39 world. This will be one of the assumptions what I've taken regarding, so such would say cleaned up KPIs compared to the PBT. I guess you have already mentioned that we have introduced operating result in our P&L some periods ago also, which is more or less the basis for the operative return on equity at the moment. This would say this pairing of the PBT on the one hand and the operating result for the return calculation will stay the same for the upcoming periods. The bad news a little bit is that the IRSB board is not laying their hands down, but they're churning out also new standards which will become applicable in the future. One of these standards is the presentation of a balance sheet and a P&L, which will more or less at the moment a uniform presentation, regardless of the industry the company is operating in. So this is also affecting us as an insurance company. And when you take a first glance, especially at the P&L out of the drafts here, the future P&L of insurance company will very much like the cash flow statement we issue at the moment here. So there will be in the future, of course, an operating result. There will be, let's say, a financial result and an investing result, and then I'll put it like this, an overall result. I think this is not the final wording, what I'm saying at the moment, but will be a new IFRS standard, which will also, would say, change the way we have to present to you and to the public our financial figures in the future.
So we want to take all this into consideration, and when we have more insights, we will reach out to you with the impact of the P&L. I hope this answered your questions.
Yes. Thank you very much. One at the very end. In terms, you mentioned in the highlights also that you will only have a Q1 and Q3 update. What will you include in that? Is that just a press release with the revenue figure and the combined ratio, or the solvency ratio?
Yes, it would be more or less that, and also we would like more discussing Q1 and 3 on our operational performance in our main markets, for example. And just to give you a better feeling on the financial position, we will include the group solvency ratio from 2023 onwards, also in Q1 and Q3. So this should give you a good overview over the financial position in Q1 and Q3.
Okay. Thank you very much.
Thank you.
The next question is from the line of Yudish from Autonomous Research. Please go ahead.
Good afternoon, everyone. Thank you for taking my question. My first question is on the CSM. Actually, in one of your slides, I think it's slide 18, you're showing a CSM of around, I believe, around 5 billion euros. I think the message we've been getting, throughout the last few months, is that it is possible actually, to get better visibility of how much of that is released in the P&L. And I was wondering whether you could actually give us some indications around that. So that's my first question. Secondly, on the risk adjustment, I was just wondering what confidence level have you set the risk adjustment on, and whether, do you see this as essentially the margins on P&C claims reserves you used to have? And then my final question is just again, I'm just wondering when will you actually be able to provide some slightly better earnings clarity? Is that with the full year results in March, or is that more like a first quarter 23 update in probably May, April, I guess?
So thank you for your questions. For the first two questions, I would like to hand over to Werner.
CSM. Okay, so let me go through the items you mentioned. First of all, the CSM. So currently we are discussing the transition balance sheet, and you see an indication on the level of the CSM here on the slide. Correct. We would prefer to indicate also the release of this CSM once we have the first full picture of an income statement. So I would like you to be a little bit more patient for such a number. In terms, I think the second question was around risk adjustment confidence level. Also here, we obviously have a risk adjustment on top of our liabilities, as I presented. The level of the risk adjustment is, or let's say the methodology of the risk adjustment is very close to the one that we are using in Solvency II. In which way we are showing the confidence level, we still did not exactly decide. So the number I cannot give you yet, but the methodology is the one that we are applying under Solvency II as well. And in terms of hidden reserves, here it's very clear on the liability for incurred claims, in particular for the P&C business, which we did have in our IFRS 4 books. You mentioned this well. Of course, this is not possible anymore. IFRS 17 requires us to reserve on a best estimate level, but the risk adjustment compensates, of course. So our transition effect also includes a bit of a release of such hidden reserves compensated by discounting effects and risk adjustment.
All right, get it. Thank you very much.
Pleasure.
Okay, and I would like, thank you, to reply on your question regarding earnings clarity. Of course, let me summarize again. The new accounting regime will increase earnings clarity, especially for the long-term life and health business through the CSM. So we will have more insights in that. And as already mentioned, we are currently producing our interim financial statements for the comparative period for 2022, and we are also running the planning process. So I really kindly ask you to be a little bit patient before we give more insights into the P&L development. This will, as soon as we have the insights, will be not before end of Q1. I think we will provide you and give you an update on these metrics. I hope this helps for the moment.
Right. Okay. Thank you. Thank you very much.
Welcome.
Ladies and gentlemen, as a reminder, if you would like to ask a question, please click the Q&A and raise your hand button or press star followed by 1. The next question is from the line of Bhavan Rethert from HSBC. Please go ahead.
Hello, good afternoon. I'm Bhavin from HSBC. I hope I'm audible quite all right. I have a couple of questions from my side. The first one would be a follow-up again on the hidden reserve topic. Can you just provide some color as in how much flex do you have in terms of risk adjustment? The point I'm trying to understand over here is it appears that a significant amount of this hidden reserves will be unlocked under IFRS 17, and a portion of that will probably be sitting under risk adjustment. So what I'm trying to understand here is how much of this hidden result could potentially flow into shareholders' equity and potentially to the P&L, which would not be taken up by risk adjustment. And that would be my first question. The second one would be on your new disclosures under IFRS 17. Now, given the fact that the liabilities will be calculated under different approaches, PAA, GMM. So should we expect it to see a separate balance sheet for profit, P&C and life separately? That would be my second question. And the third one would be on your KPIs, particularly related to the combined ratio. Now, under IFRS 17, the combined ratio would be more on a gross earned basis compared to the IFRS 4 world, wherein the combined ratio is more on a net earned basis. So should we still expect to see any form of net earned basis reporting even under IFRS 17 basis so as to help us make a better comparison of your combined ratio with respect to the IFRS 4 world? And also, how should we read this with respect to, the 95% combined ratio target that you have? So those are the questions that I have. Thank you.
So thank you very much for your questions. I would like to hand over to Werner for the hidden reserves topic.
Okay, to follow up on the hidden reserves, and I believe you are referring again to P&C in this case, and how much is released, and is it released into, or is it flowing into equity, or would this release be shown in the income statement? So any kind of release in the transition balance sheet is a pure equity effect, of course. Yeah? So this reclassification or transition effect is not visible in any income statement anymore. As we are talking indicative numbers, you have seen this on a certain slide today, the transition effect, for example. What I can say is that, as mentioned before, the discounting effect and the risk adjustment make up for a big proportion of the hidden reserve. Yeah? So can compensate to a very large extent, but not fully. But a very large extent is kept. So the transition effect on P&C hidden reserves is not so significant as you have seen in the past in Solvency II disclosures, etc., because of the discounting and the risk adjustment. I think that's.
I hope this answers your question. Regarding the new disclosures, I already elaborated or explained that the segmentation will remain unchanged, but I will hand over to Roland to give you even more insights.
Thank you. For the time being, VIG will stick to the segmentation we have at the moment, and this is very much dependent on the IFRS 8 actually, because according to the standard, we have to present the segmentation, the balance sheet and P&L in the way we steer our group. And we don't steer our group according to P&C, life and health here, but we steer our group according to markets here. This is one of the reasons why we'll stick to the present segmentation also in the IFRS 17 world. The other one is, of course, as we presented before, yes, we have these three models here employed, the PAA, the GMM, and the VFA, but this is not a pure model for each P&C and for pure life and for pure health. So this is also, we have in most models also small parts of the other products here included. So this is not a very pure mix here. So we will, to summarize it, we will segment our P&L and balance sheet still in the way we do run our group, and this is according to markets. Regarding your third questions, the combined ratio, how we will calculate it in the future and how we will present it, this is one of the items which is very much in the discussion within the group. Of course, there's also the possibility to publish a gross and a net combined ratio. And also, as you know, the formula during all the peers and all the other markets sometimes differ a little bit. For the time being, we will expect that the calculation, the presentation of the combined ratio, also the new IFRS world, will be quite similar to the old IFRS 4 combined ratio we published in the past.
I hope this answers your questions. Thank you very much.
Yes, it does.
There are no further questions at this time, and I hand back to Liane Hirner for closing comments.
Thank you, everybody, for your interest or ongoing interest in VIG Group. Let me add here that a replay of this presentation will be available online in the next days in a separate sections of our ER website. So you have the chance to listen again to us as much as you want. And we will also provide the presentation as well as all other publicly available IFRS 17/9 material of VIG in this section. Now let me end this conference by wishing you all a happy festive season and all the best for the new year. And goodbye from us three here and see you again in 2023.
Goodbye.
Bye.
Bye.